Hi, this is Pat McDonald, your host for Vote for Vermont, where our tagline is listening beyond the sound bites. Joining me tonight is Ben Kinsley, co-producer of the show. Ben, how are you?
Good, thank you.
Good. And our special guest is Kaj Samsom, who is the Commissioner of the Department of Taxes. Welcome.
Hi, thanks for having me.
Thank you. Thank you. So we always start out with our guests telling them a little bit about themselves, and you can just start right in.
Okay, well, been tax commissioner since Governor Scott was appointed, so a little over a year now. Before that, I was deputy commissioner of the insurance division right in this building at the Department of Financial Regulation. I've been there for 10 years, started as an insurance examiner, certified public accountant, started state service actually for the auditor's office when Randy Brock was auditor.
Oh, great.
And prior to that, had done some time in public accounting and enjoy taxes, which is a rare feature. So, and
my
enjoy.
vote.
I enjoy state service. I really like working in government. I like the combination of policy and financial issues, and so I think this is a good fit.
Great.
I'm enjoying it.
That's great. I didn't realize you had quite the extensive background you have, especially Bishka. That has changed names and changed responsibilities for years. There's been all kinds of things put into Bishka. So.
Right. The HCA part of BISHCA used to be a separate kind of authority, and then it became part of the department, and now it's really kind of the Green Mountain Care Board.
Exactly.
So things are going full circle. So
yeah, that's great. Well,
what's
at least
next?
No surprises when you go into the tax department, because that's you got quite a bit of responsibility.
Yeah, 29 tax types. That was really kind of the transition. It was interesting to see how my role in DFR in the insurance division was much more policy focused, and then at the tax department, it's much more operationally focused. You know, 29 tax types, and everyone can name 2 or 3 and think of those, and they're the major ones. But there are many little taxes that we administer as well.
Good for you.
And you have some resources now at the tax department for doing economic modeling too now, or you can do some more predictive stuff about you know, what potential taxes either the governor is looking at or the legislature is looking at. Has that really been helpful for you? That's kind of a new thing for the tax department, right?
It's new, the VTAX system, and then kind of an add-on that queries it or can do some modeling based on the information in there. You know, that transition started 3 or 4 years ago, a very big software overhaul, but it's complete, and we're proud to say it's you know, ahead of time and under budget, which for an IT project is an impressive result. But that chain bridge is the modeling software, and the JFO, the Joint Fiscal Office, has access to that as well, and that allows you to, with real taxpayer data, and it's all confidential obviously and kept that way, but to model certain changes in tax code and tax policy and run them through with actual real taxpayer data. So you can really hone in on, well, what if we changed the standard deduction like this, or what if we added a credit on this number, you know, and you can get some pretty good revenue estimates. Yeah, it's been helpful this year.
Yeah, I've always talked about, and we're getting off of already we're off the questions, but in the Department of Labor, they have got economic data over there that is just so valuable. I've always wondered why other departments don't use that information between your system and the Department of Labor.
Right.
You know, put those economic guys out of business, I think. But it's great to have that data.
Yeah, I think we're just kind of at the tip of the iceberg of being able to use it for revenue modeling, for tax compliance, all these things.
Great, good for you.
It's a great system.
Okay.
So a lot of the questions that we want to ask are related to stuff that's going through the legislature. I know you spent quite a bit of time up there this year, as well as kind of the end of last year. There's a whole lot of things going on, and we'll touch on a few of them and probably dial in on a few other ones. So in December, the president signs a federal tax reform plan that went into effect this year. January 2nd, you put out a panel, or you put together a panel of tax experts and held a public hearing. What what have you learned since then about the impacts to Vermont from this federal tax overhaul and what that's going to look like for Vermonters?
Yeah, so since December 22nd, and actually before that, we were using some of this software that you asked about to kind of model what we understood, from the Senate version, what was looking likely to pass. And you're right, it's effective January 1st, 2018, which is the federal taxes people will be filing in spring of 19. What we've learned is that the biggest single factor as far as how it impacts Vermont tax calculation is the elimination of the personal exemption, which, we're diving right into the weeds of a tax return, but for anyone who files taxes, whether you're a single filer or a married filing joint with 2 kids, you basically get one personal exemption for everyone in the household. And for me, I'm married filing jointly with 2 kids, that's 4 exemptions. The value of those under this federal tax reform plan went from about $4,000 to 0. And what happens in Vermont, in the Vermont tax calculation, is that we borrow that number from federal code. So when that came to 0, all of a sudden Vermont taxes, the bigger the family, the more your Vermont taxes go up if we don't do anything. And people wonder, well, if it's a tax cut at the federal level, how can it be a tax increase at the state level? And the reason is that even though your taxable income goes up at the federal level because those exemptions go away, they've lowered rates, they've doubled the child tax credit, they've doubled the standard deduction, and we're not tied to the child tax credit or to federal tax rates. So we kind of see the federal tax package as a series of ups and downs that turn out favorable for many filers. In Vermont, we've seemed to have a lot of the ups but not the downs as far as our connections to tax code. So what we've learned is that, to get into specifics, that 53% of Vermonters will see a slight reduction, totaling about $12 million in their Vermont taxes. This is if we do nothing. And the remaining 47% will see a more sizable increase of about $42 million in total taxes.
And when you're saying if we do nothing, what are we thinking of doing?
So what the governor proposed and what we designed in the administration was a tax reform package that essentially looked at all cohorts of filers, age, income, family size, and said, how do we keep people where they are before the Vermont impact of the Tax Cut and Jobs Act? And we put forward a plan, introduced it to, or presented it to Ways and Means in hopes they would take it up as a committee bill. And that bill kind of simplifies the system. It defines our own exemptions in law. It defines our own standard deduction. There are other features to it we can get into, but essentially the goal is to simplify the tax system, broaden the base a little bit, which means taxable income goes up a little bit, but rates go down to arrive at the same tax due. Which helps us kind of in our interstate tax competitiveness.
Gotcha.
As far as, you'll see now they're really
Some people are looking at rates. They're looking at rates for New Hampshire and New York and Vermont, and they're like, oh, Vermont's better rate-wise compared to. Yep. It
doesn't tell the whole story, but like it or not, that's what a lot of people are looking at is, Vermont's got the 6th highest rate, which is true where we are now. So if you broaden the base a little bit, you add stability to your revenues and you can lower rates. So we designed a system that simplifies taxes in Vermont, takes some of those linkages to the federal system and says, we'll put in our own personal exemption in Vermont law, and we'll put in our own deduction amount. And as a result, we were able to lower rates in our proposal by 0.2% across the board.
And what does that do to our needed income in revenue into the state?
It keeps it the same.
It does.
Yeah. The whole design, so taxable income, so let's say taxable income was 100 into the old system and your rate was 5%. Maybe in the new system, taxable income is 110%, but the rate is 4.5, or $110, but your rate is 4.5, or something. Somehow we're landing at the same.
At the same place. So there's no loss in revenue.
No.
Okay.
No, the governor was clear: no new taxes and fees, and what the do nothing option doesn't honor that because it's accidental.
And this is all for next year's filing.
Yeah.
Because interestingly, my husband, things are taking effect now. He got $100 more in, I don't know whether it was one income that he gets his pension or something.
Right.
He got $100 more because of the taxes, but
Federal.
Federal?
Yeah.
Okay.
Yeah, so
So some of
withholdings.
it now and some of it's later?
Yeah, well, if you're have a source of income like wages or pension where
Right.
there's some withholdings happening, because, like I said, for the most part, I think the majority of Vermonters are seeing a reduction in their federal taxes, and that's a policy objective you can achieve if you spend $1.5 trillion on a tax plan. If you have, a checkbook.
Just to round it out.
Right. So, it's fair to say that most people are winning under the federal plan. So if you're a wage earner, and as am I, your federal withholdings, the IRS adjusted their 2018 withholding tables effective February 15th. So employers, some of them did it earlier, adjusted withholdings down. So most people are seeing more in their paychecks. Vermont, if we were to just go by the, assume that this $30 million accidental tax increase were to happen, we would have adjusted our withholding tables up.
Right.
But, our plan is to not let that $30 million trickle through, to pass some type of hold harmless reform, so we have not adjusted our tables.
So now, years ago, we used to be really coupled.
Yeah.
And when did we sort of,
I think it was around 2000, 2002.
was it, we really pretty
Yeah.
much, it's only on gross income or something that we,
We used to take your
per
federal
percentage.
tax and multiply it by 24%.
exactly, I remember that, 24%.
Yeah.
Yeah, but we did that back in 2000, we decoupled that?
Decoupled somewhat. I mean, you're always somewhat, that's the extreme coupling, is if you just take a percentage of your federal tax. Where we are without, in 2017 and prior was pretty tightly connected to federal taxable income. Where this plan takes us is starting with adjusted gross income, which is a higher number, and then rather than saying take your federal adjusted gross income and subtract the federal standard deduction, but not this part, but yes, this part, it's where we were. Now we're saying take adjusted gross income at the federal level under the governor's reform plan, and take this number out of Vermont law, deduct that, and now it's under our control more.
Thank
So
you,
we're less
Governor.
vulnerable to the whims of the feds. Yeah.
Yep, and that would join the majority of states that have done that. And as far as what happened with the federal tax reform, adjusted gross income was largely unchanged. And there's a lot of speculation that the reason for that is both red states and blue states, the majority of states, I think it's 26, 28 states, are really tied to adjusted gross income. So whether you were a red state or a blue state, you were telling your delegation as a tax commissioner or governor,
Right.
don't mess with AGI.
Don't touch
Don't
AGI.
touch it.
Yeah.
Yeah, so we
Yeah.
want to
Leave
be there too, so that when some of these provisions may expire in 2025, we don't want to be scrambling again and seeing an accidental tax increase, decrease, or whatever. So I think it makes sense, and it's there's bipartisan support. The Ways and Means Committee likes the idea and had already talked and made some moves to more formally go to AGI. So
I don't think people would be thrilled. The more kids they have, the worse their taxes
Yeah.
are. So this was a good plan.
Yeah.
Good thing.
Well, I was going to ask about the response from the legislature, because it would be really easy to just say, "Oh, here's a free
Right.
$40 million. We're going to go run with it." And
Yep.
because even just in the education fund, there was a $40 million
Right.
hole from last year that was created by the legislature. So I think there's a real temptation to just take something like
Take it
that
and
and run
fill
with
the
it, because
gap.
they can just say, "Oh, it's the Fed's fault."
Yeah, and there was early messaging, and I think the governor's early messaging on this helped set the stage to say this would be an accidental tax increase, and I'm saying no new taxes and fees, and was very clear that we were not going to keep our eye off of that, or we were going to keep our eye on that and find a way to mitigate it, and including not adjusting withholdings upwards to start collecting money that we hope legislatively to prevent.
So is there anything else on the federal level that we should be paying attention to or worried about?
I would say one area of concern for nonprofits is the charitable contribution impact. So because one of the things that's happening federally is they've doubled the standard deduction. So whether you're single, married, filing jointly, head of household, the standard deduction has roughly doubled. And for those of you not living in the 1040 or in
Right.
tax code, you have the option of saying, I'm going to itemize deductions like my mortgage interest, charitable contributions, state and local taxes, those type of property taxes. You can itemize those or add them up, and if they exceed the standard deduction, you can take those. You take the greater of the two. The federal bill, Tax Cut and Jobs Act, essentially almost doubled the standard deduction. So many people
you're not
looking
gonna
at that comparison are going to take the standard deduction now. What that means is whereas before they had some tax incentive in giving to charity, they've lost that tax incentive.
Right.
And so it's anyone's guess how much, I'm sure there are studies on it, but I'd have to guess how much that impacts philanthropy.
Oh, I see. When you said nonprofits, you're worried about their revenue coming in.
Yes.
Right.
Oh.
Because suddenly
Yes.
a lot less
Well,
of that is
yeah, it's
now
not worth it.
taxable. Right. Yeah. So it depends
Yikes.
partially on, on how much you itemize versus
Yep.
not. So it's probably more likely those middle income folks that are.
Yeah, so we
know.
estimate that, well, not estimate, we know that about 30% of Vermonters, up through 2017, itemized deductions at the federal level.
Sorry, what was that percentage?
30.
30%. Okay.
And we, through this modeling software you asked about, we're able to model that if they act rationally and take the greater of the two, the new doubled standard deduction, that'll get to less than 10%.
Wow.
So you're looking at less than 10% of Vermonters itemizing, or a third of the people who used to itemize. And so there is concern about how is that going to impact Vermont charities, and are people going to be less likely to say, oh, let's get that taxable income down this year and give $1,000 to whomever charity. So part of the governor's plan included a charitable contribution credit at the state level, and that that usually behavior is more influenced. Federal taxes are 3 or 4 times what the state income taxes are, so there's more incentive if you can do that at the federal level, but we can't control.
Because most nonprofits really live close to the margin all the time.
So
Yeah.
they're nervous right now,
Yeah, I
I'm
bet
sure.
they
And they oftentimes build their fundraising plans off of tax season, right?
Right.
A lot of nonprofits ramp up in October, November, December for those
Right.
end of the year fundraising campaigns using the tax incentive, right?
Yep, they'll send out communications and say, get your donation in
Yeah,
before
right.
December 31st, so it's
Ouch.
tax,
Yeah.
I feel bad for them because they work hard and they right down to the wire with
And
dollars.
it's a there is an overlap with government. Obviously, a lot of the services provided by nonprofits kind of supplement or even supplement what government has to do. So there will be an indirect, if there's a pain felt or lack of donations coming into some of these nonprofits, it's possible that some of that burden falls on the government to take care of. So it has some indirect
Right.
consequences.
Right. That's good.
So, one of the big topics that I think is on everyone's mind right now is the tax overhaul that's coming, the education tax overhaul that's coming out of the House Ways and Means Committee. You spent a lot of time in that committee on this piece of legislation. It's changed fairly significantly within the last week.
Yeah.
There's definitely some retooling of how the tax rates would work. Originally, it would have gotten rid of income sensitivity and then split the homestead portion of the education tax revenue into 2 buckets: an income bucket and a property tax bucket. Because right now we have an either/or system. You either pay an income tax or you pay a property tax.
Right.
This would split it so that you pay both, and you just pay a lower rate on each.
Yep.
So what were your reactions to this bill, both initially and then the new version of the bill, and we can get into that.
Yeah, because the original bill, just for clarity, was the 2-bucket thing, and now they've
It's still a 2-bucket thing, but
It
it's
is.
complicated.
Okay.
Yeah.
Then you lost me.
The initial bill, well, first let me start by saying this. So the Ed Fund, only about 27% of the education funds, which, funds our public schools, comes from the residential property tax. And you talk about the buckets of income versus property in the existing system, there's the pure payers that pay their property tax bill, and then the ones that pay based on income.
Right.
But they're still paying property taxes. They're just getting an adjustment based on their income, which is computed, through several forms that you file with the tax department. So our initial reaction, another major source of funding in the Ed Fund is about $400 million of general fund transfer.
Right.
Right.
And so we as a tax department have resisted the idea that there's no income tax in the Ed Fund, because that general fund, the income tax, the personal income tax, about $750 million a year, goes into the general fund.
Right.
I believe 100% of it. And then there's this general fund transfer to the Ed Fund. So what we had done was an analysis kind of conceptual, but to say on average, if X percent of my income taxes, your income taxes, ends up winding its way into the general fund transfer into the ed fund, under our current law system, aren't we in effect paying property taxes and funding education through a portion of our income tax? And so we did an analysis at different income levels, which have different tax brackets, about how much people are in fact paying based on income. And the reason we did that is that there was an argument out there, and there were some presentations in the past that showed, tried to show a picture of at least property taxes or education financing as being regressive, meaning as your income goes up like this, your house value generally goes like this, but it tapers off, you know, so you might have someone earning $300,000 a year living in a $400,000 house, but that doesn't mean that someone earning $600,000 a year lives in an $800,000 house.
Right.
It's not linear after that. So
Yeah.
that was used to make the argument that wealthy taxpayers in Vermont, or wealthy homeowners in Vermont, weren't paying their fair share into the ed fund through property taxes, because you know, you could be a millionaire and still live in a $500,000 house, just like someone who, you know, we have people in $500,000 houses making $40,000 a year and getting huge property tax adjustments on that.
Right.
So we had said, well, you can't quite make that conclusion, because that the property tax or that ed funding is unfairly skewed towards, you know, or isn't properly funded by higher income, because the higher income piece comes in the general fund transfer, where income taxes go, where, you know, 1%, the top 1% of Vermonters pay 25% of Vermont's income tax. And so that's a very progressive income tax system. So that was a foray into the weeds a little bit,
right.
But that was
Yeah.
kind of relevant to the discussion, we thought. Our initial reaction to the first version of the House Ways and Means plan was, you know, I think there was some appeal to the idea of eliminating income sensitivity, right, and creating a, you know, 70% of Vermonters pay some reduced amount off their property tax bill based on income. And that causes a lot of confusion and theories about whether people are truly engaged in their local budgets, and when they perceive that they're insulated based on their income to pay any of the property tax consequences of that. So House Ways and Means talked a lot about more direct connection and re-engaging folks in local spending decisions. So they basically bought down the property tax rate and eliminated an income sensitivity with a new income tax, new tax on income. So a lot of moving parts there. So that part had some promise to kind of rationalize the system a little bit, I think,
right,
on
yeah.
property taxes. But some of the problems we saw, you know, we're working for a governor who's committed to no new taxes and fees, was that the income tax portion that they were adding was really top-heavy and really steep.
Really progressive, yeah.
Yep, and we're already probably the third or fourth most progressive taxed state in the country. So there wasn't a broad discussion, a policy discussion in the committee about we need to be more progressive and this is why. It was really just, I think, an ability to raise money to buy down that property tax rate. But specific concerns would be you'd be taxing renters who, you know, when you tax income, you're taxing everyone who earns income, including
right.
renters who, if they're, you know, not under $47,000, aren't getting a renter rebate or anything like that, and are theoretically already paying for education through their rent, through the
right, because
landlords.
landlords are
Landlords have to
paying
pay
the
it.
non-homestead property tax
Right.
rate, which is the statewide flat rate.
Yep. And so, and then the other area that I think for me was even more concern around economic growth was that non-residents would be paying this new kind of surcharge, and that remains true in the new plan too, that it would apply to all Vermont income. And we have significant out-of-state investment in Vermont businesses by non-residents. And if those are investments in pass-through entities like partnerships, LLCs, S corporations, that becomes Vermont taxable income. And the original plan effectively added about 2.5% to the top rate, making us second in the country. And we are concerned that and I think rightly so, that an out-of-state investor looking to make an additional investment in a Vermont company might say, well, wait a minute, that's effectively a 20 to 30% increase in my taxes. That changes my return on investment. Maybe I'll take this investment and put it in another state.
Right.
And that's a very real decision. Having worked in public accounting, I mean that's what accountants are doing for their clients
Finding the best place.
is modeling return on investment and that sort of thing. And it is a reality. So we had some concerns with the kind of interstate tax competitiveness, and we did some diving into the data, and I was surprised. But we checked it and double-checked it, how many Vermonters we have, not Vermonters, excuse me, how many people we have working in Vermont, getting Vermont wages that don't live here.
That don't live out of state.
Something like 30,000 30,000 taxpayers with wages, cumulative wages, 700 or 800 million. And so then there's a question of the people who are employing them. If they are competing, and we think a lot of those are along the New Hampshire border, if that employer is having trouble filling that position as it is, and now that employee perhaps in New Hampshire is looking at 2 job offers, one in Vermont, one over there,
guess what?
There's an entire, you've just really exacerbated what's already a competitive disadvantage for taking the Vermont job. So a lot of concerns there.
Which is probably why we ended up with an income tax system, which is really a rebate system.
Right.
That's income sensitivity. And the problem with it that the committee was trying to solve was making it simpler, because it's complicated. It's looking back at income from last year, applying it to your property taxes this year to keep you to 2.8% or whatever the adjustment is for your local spending.
So what is the plan now? I mean, they've changed to this surcharge thing, what, a week or so ago?
Yeah.
I mean, all of a sudden, bam, we're talking surcharges, and I don't think people even realize, where are we? What does it look like now?
Well, and the surcharge is basically adding income sensitivity back into the equation.
Right,
yeah,
exactly.
And paying for it in the income tax side instead of the property tax side, because originally you were raising your property tax rate in order to pay for income sensitivity, about $170 million. So
is this going anywhere, this latest idea?
Well, I don't know. I would say
they're sort of mixing and matching the tax code with I mean, it's just very
well,
confusing.
we're not. The administration's not happy with that. We put forward what I think was largely adopted by the committee. They put forward a bill, H911, that adopts, I'd say, in large part, 90% of what the governor's hold harmless tax reform plan included, but then adds in this income tax surcharge to raise an additional $60 million, and changes the funding formula. Removes the excess spending threshold for school districts. There's a lot of stuff going on, and I think it adds a lot of politicization and controversy to the federal for the tax reform plan that I think we could have and would have found 90% common ground on with the majority in the legislature. Now there's this thing, this funding formula change and the income tax surcharge for education that I think will be robustly debated just within the majority. There were a lot of votes in Ways and Means. When they passed that out of Ways and Means, there were a lot of reluctant yeses.
I hope they heard a lot in town meeting, because I know our poor representative was inundated with questions.
Yeah. And it's
And,
difficult to explain, and that's part of the problem is they were looking to make it easier to explain. They ended up with something that's probably harder to explain.
You're absolutely right. They were looking to make something simpler to say, that the budget you vote on will get you a tax rate, and everyone in town will pay that tax rate, property tax rate.
Right.
Now, of the 70% of Vermonters that are income sensitized on their property taxes, that stays in place, but those folks are also paying an additional income tax surcharge to pay for education. So we're charging them more in the income tax, but still giving them the same back on the property tax. Great. So now it's difficult enough to take random Vermonter on the street and say, how much do you pay towards education? Now they have to go through all the same thought process and figure out, income sensitivity, what my school spending is, et cetera. Now they also have to figure out what they're paying on the income tax surcharge as well. So it did not make things more simple.
Yeah, people were a little frustrated. I was listening to the conversation. We just had one of our reps there, and she was just getting bombarded.
Yeah.
And she's very smart. I'm sure she answered all the questions, but people
Right.
went away with
Yeah.
these
Yeah, well,
stunned looks on their face.
If you weren't on Ways and Means, I wouldn't blame you for not
Yeah.
being prepared for town meeting, because the
Right.
thing was put together the weekend before the last week, and passed out of committee on a Wednesday, and
Right.
with scribbles on it up until the last minute. So
Right.
Yeah.
Yeah.
Well, this was Ann Donahue. She's always pretty sharp, but,
Right.
but I think she must have been struggling too, because you only had a couple of days to
Right.
understand it.
I think what the upside of it for messaging, if you're for the plan, would be, it reduces the average property taxes by 10% or 15 cents. However, it just takes it out of a different
Now,
pocket.
I may be complete, but this is just for individuals. That's not second
Correct.
homeowners or businesses.
Right.
Because
So
those
we're gonna
fall
get
under
into
the
our poor
non-homestead.
businesses.
Yeah,
Okay.
those fall under non-homestead.
So this
And
whole
that-
discussion
yeah.
is just for me,
Yeah.
for individuals. not
Yeah,
for-
and that was another opposition we had to it as well, is this does nothing to the
for
non-residential
business.
rate.
Yeah, or businesses. I
Right,
mean, they are
right.
just, I don't know how they manage.
And just for the folks at home, the education fund is roughly broken up into 3 categories of revenue. You have your homestead property taxes, non-homestead property taxes, and then other revenues, including the general fund transfer,
Right.
sales and use, meals and rooms taxes, those types of things that come into
Right.
the fund. And it's about roughly a third of each. So it's 1/3.
Oh, is it? I didn't know that
1/3
part.
homestead,
1/3,
1/3 non-homestead, 1/3 other stuff.
Well, and you're right, businesses moving in here, they look at all this stuff.
Yeah.
And they move their business, but they're also here personally, so we get them both times, don't we?
Right,
Excellent,
right.
good for us. So do you think that anything's going to come out? At this point, I can't imagine, because it's only in the House, it's got to go to the floor, or
Right.
I don't know where it would
It's
go
going,
after.
it's in education
Oh,
now.
so it's
yeah.
been to Ways and Means, Education, maybe to the floor, and then to the Senate, maybe not.
Right, yeah.
I'm not sure how much the education committee is going to like it.
Now, what about the adjustment for the federal tax that you were just talking about?
Yeah.
Is that part of this?
Yeah, it's all in the same bill,
Oh, that's
and
not
Oh, wow.
we really want that separated.
Yeah,
we
that-
want
I
to
would
say,
agree with you.
Here's what, like I said, we should be able to find 90+% common ground on this hold harmless income tax reform, but now it's all in the same bill with this new. So
Oh, that's bad.
they've lowered rates by 0.2% across the board, and then added a surcharge and added a change to the funding formula and
Whoa.
all that stuff in one big bill
Yeah.
that I don't believe needs to be in one bill.
No, because that's really important to
Yeah.
be able to
So that's-
counteract the federal impact.
Yep.
Well, the other thing that's in there too is, and you talked a little bit about this, is really tying the taxing decisions. You're voting on your school budget and tying that back to the local community so that you're feeling the impacts of those voting decisions.
Right.
There's a piece in there that moves the ratio from about 45% to closer to 100% for when you vote a dollar more in spending under the current Act 60 model. You see about a 40-cent
Right.
hit on your tax rate, right? Under this new formula that they have in this bill, it moves it to more when you see when you increase a dollar in your spending, you have about a dollar equivalent increase in your tax rate.
Right.
So that's what they call it, increasing the slope
Yep.
for local spending
and that
decisions.
part, has some merit, and we want to explore those type of things further.
Right.
But it's important to note that those type of formula changes that basically turn a school budget into a local tax rate based on
Right.
per pupil
People
spending.
still don't understand.
I know.
I mean, they
Yeah.
really don't. I was at a meeting in Barrytown with the school administrators, the people that, the board that puts the budget together. The questions, it's still the same questions from, 10 years
Yeah.
ago.
Yep.
People don't understand how your school can be as frugal and as cost effective as possible, and then you still get a big increase.
Well,
it's just
and
mind-boggling.
part of that is, I think, they did make a change 2 years ago with the yield that they're using.
Yep,
right.
I
It makes it a little more easier to
Yep.
explain because now you have a dollar statewide
Right.
tax rate. I think maybe
don't get it.
Yeah, people don't get it, but it makes it easier to explain if you have a dollar
Yeah.
statewide tax rate.
Yep.
You can say, hey, okay, so the yield is $10,000
Right.
this year, right? So you get, if you're spending 50% above the yield, you're spending $15,000, you're going to be 15% above the statewide tax rate which the statewide tax rate's $1, so your tax
Right,
rate's going to be
$1,
$1.50.
right.
So that's
Divided
easy
by
to,
your CLA.
That's enough.
but that's yes,
We're
but that's
moving
the but that's generally what you
Yeah.
can
Right.
you can explain it to
Yes.
people that way, and then
Right.
you have your CLA, but that's it complicates it more, but that's essentially what it is, right? And then if you're paying an income, it's the same thing. If you're paying on income, statewide income tax rate's 2.8% or 3%, you're going to be 50% above that. You can figure that
Right.
out pretty easily.
I don't think, are towns required to do an appraisal every so many years? Is that a state law?
I think every 10 years, but I'm not sure how that's enforced. I think what happens, or I know what happens, is that there's a portion there's a holdback or some contribution by the state to the towns that over 10 years
Oh,
they
they
should
get
have,
it.
it funds a large
'Cause
portion
I
of what a
remember when
reappraisal
Berlin, it
would.
was like, I don't know, something ridiculous. It was way
Right.
more than 10 years, and some of us got nailed.
Right,
But then we were told, well, but you got away with it for
right.
10 years. But I think if we keep up with the CLA, it wouldn't be quite such an impact, I think.
Well, they've talked about getting rid of the CLA too, because because it makes it difficult to tie it back.
Yeah,
Yeah, this is very complicated.
Mathematically, it kind of all makes sense, but for transparency and for people understanding what they're paying, why they're paying, and who they're paying, it is complicated. And I can't say that the education portions of this bill out of Ways and Means make anything simpler. But you talked about the slope, and those features have some promise to more, to make the consequences of being really high in per pupil spending make that more directly related to the taxes paid
Right,
in
make
that
them
community.
make them feel for it.
Is there anything else we have to worry about in this bill besides what we've just talked about, or that's pretty much?
Isn't that enough?
I think so. I think getting the fix to the federal is really important to get
Yeah.
it split out. And I don't know, maybe our viewers can help a little bit
Right.
by getting, because that would be outrageous if we didn't have that.
Well, here's what would
Hold that
happen if we exit this session without a bill to basically prevent that accidental tax hike.
Right.
And that's what it is. No one
Right.
planned for it. No, it took a couple days or weeks after the plan passed at the federal level to understand what it was going to do to
Right.
Vermont. But if we don't get something in law to change the Vermont tax calculation in 2018, here's what happens. I have to adjust Vermont withholdings up in June or May,
Right.
whenever it's clear nothing's going to change, so that people are properly withheld on their wages in 2018. Because I'd be doing that in June, I'd have to do it at twice the increase to catch up for January through June.
Right.
So people will see it coming out of their paychecks, and again, we haven't heard any intention to spend that. Certainly not from the administration, and some ideas maybe in the legislature, but ultimately they put forward a plan in this H911 that did not increase revenues or allow any major part of that to go through. So we need to fix it, and it should be in a separate,
We
standalone,
have to
clean
help with
bill.
that, get the word out.
We'll keep an eye on it for
I
sure.
love the number,
Yeah.
9/11, hello.
Yeah. One other thing that I want to mention while we're talking about education property taxes, Governor Scott has called on the legislature to essentially scrap this bill and look at other ways of reducing education costs. Are there any options on the table other than potentially increasing the slope for
Right.
higher spending towns?
Well, there's been testimony that I've witnessed, and then there was also a lot of discussion at the December Education Summit about special education costs. I happened to be in Ways and Means and stuck around for a presentation by I believe it was a UVM study that was done, and it really showed that changing, and I'm not at all deep into education policy or special education, but the takeaway was clear that we spend far more on special education than most or all other states. And the question was asked by Ways and Means members of that presenter, well, how about our outcomes? Are our outcomes better? And there was an unequivocal no. We have no evidence that outcomes are any better at this level of spending. And so I think there's a lot of bipartisan support for changing to this model of how we fund special and deliver special education. So there are savings available there. And the other big item is that you've heard the governor talk about is student to staff ratios. We are the lowest in the nation, 4 point something to 1. Four and some decimal point students to 1 adult. That's the lowest in the nation. And even if we moved, I think, something like to 5 to 1, we'd still be the lowest in the nation. Part of that's driven by the fact that we're rural, we have small schools. Right. But at that education summit, a lot of the discussions from education leaders themselves said, yeah, we can do that, and we understand we need to do that. We need to find a way to, not be so staff heavy.
Right. 4 to 1 is.
Yeah.
I don't think you need much study on that one.
Yeah. Well, and it's
That's sort of
difficult.
like,
We've been trying to address this for years, and this is, so 2005 we passed a bill that encouraged school districts to start consolidating, and one district did it. And then in 2009 we passed another bill that increased the incentives and then also made it easier for districts to figure out a configuration.
Right.
Past that, still one more district merged. And then we have Act 46, which is basically the same model that we've been working on for the last decade and a half, but is now mandatory. It's a mandatory process.
Right.
So there's some movement there. It's even Act 46, though, even a mandatory consolidation bill is proving to be very difficult.
Coming along kicking and screaming.
Yeah.
It's a big decision.
And there's there's some districts have found savings, but it's not across the board.
So before, we only have about 50 minutes left, and there's a couple of things, given my age. Social Security.
Right.
Where is that written? Is that in the governor's budget? I didn't see.
So it's actually in 2 places. It was in the, I think it's H839 or 819 is the affordability package, also known as the miscellaneous tax bill.
The old Christmas tree. Okay.
Yeah, so that included 2 exemptions that were priorities for the governor, and that was Social Security, a partial exemption, exempting more of Social Security income than we do currently, and then also a military pensions exemption. So that bill is still in Ways and Means. It also has a lot of taxpayer protection language in there that came out from our taxpayer advocate. But it also was part of the Social Security piece was part of the language that we presented to Ways and Means in hopes that we get a committee bill.
Because a lot of states just don't tax Social Security at all, period.
Right. There's very few states that have no exemption. We just basically adopt the federal, the federal government doesn't tax all of Social Security, and we just piggyback off of that.
I see.
So at the most, well, it's like 15. There's a phase out based on your income. But what this did was the governor's plan increased the thresholds and phased out more of your Social Security income at the lower to middle income ranges. So Ways and Means did include that in this bill we've been talking about. So they liked that. They included it, and they did it all in 1 year. The governor's plan, just because of constraints on revenues, phased in the change over 3 years. Ways and Means put it all in there for 1 year. So we're still analyzing how they afforded that, and there's always a give and a take. So what changed? So we're looking at that, but
that's a real sell for retirees who want to move somewhere. I don't know if we want to get more older people here. Since what are we, the second oldest?
Second oldest behind me.
Second oldest, yeah. Yep. There you go. But anyway, I think it's a good idea. It's a really good.
And don't get too excited, because it doesn't exempt all Social Security income. It's just, it just expands those thresholds on the lower to middle income to exempt more or all of their Social Security up to about 60.
We're headed in the right direction.
Yes, right. It's certainly a step in that direction.
There's a debate about this too, because we also tax military pensions and earnings, and that's an potentially easier discussion to have, because that's like 15, 16 million, I think, that comes in off of that. The military tax. Social Security is like 65 million, I think.
In total?
In total?
Yes.
Yeah.
Yeah, the military, I believe, exempting that was more of like a $4 or $5 million price tag.
Yeah.
The Social Security in total is like 60 million. So,
so
this partial exemption, was had a price tag of total price tag of around 6 million. They included it this year and found some savings by doing it in 1 year. closer to 4.1 or something, 4.7, 4.1 million. So that's what we're still analyzing.
Some of us old people like the concept, so.
Well, yeah, and you also have to think about, what's going to happen 5-10 years down the road, because we've got a bump of people that's going to be retiring in the next 5 to 10 years.
So where's the carbon tax these days? All of a sudden, I haven't heard or is it still chugging along? Are you involved in that at all?
Not really involved. I think the fact that I haven't been involved in the discussion means it's not chugging along too fast, because ultimately, if it has legs, they'll have to discuss the actual administration and how we're going to implement a tax like that, and that's where the tax department would get involved. But I haven't been too involved in that. I know there are a lot of concerns with it.
Let's keep it that way, that's good. Because I know that most people are not thrilled. We've done a couple of shows on the carbon tax, and it's just ridiculous.
I should watch those, because I think I do need more education on that.
Well, it's mostly Mr. Coda. We've had him on a couple of times.
Matt Coda. Yep.
He's wonderful.
Right.
For a while there was a couple different proposals that were floating around. Now it's mostly seems to be the Essex plan is the one that's kind of floating to the surface.
Which he's not thrilled about either. So anyway. So and what else did we want to ask you on the property valuation review? That's part of your department as well. The PVR. Could you talk about that as what's happening? There's a bill in play that would eliminate the PVR boards, and I don't understand that at all.
The appeals board, it turns out, hasn't met or actually heard an appeal.
Years?
Yeah, in 3 or 4 years, and that's maybe 3 or 4 years is just a reflection of what I heard from the director, who's only been there 3 or 4 years. So who knows before that? So I think that the plan there is to say we can deal with that through our tax department appeals process. So just rather than, PVR used to be its own department, essentially.
Because they used to help municipalities with, computers.
Yeah, they still do.
Because when I was on the select board in Berlin, we were always calling them PVR.
Yep.
I'm trying to remember the guy's name.
District advisors are out and about the state helping out listers and folks in municipalities. It's property appraisal is as important to the state with the statewide education tax, property tax, as it is to municipalities for their municipal budget. So we provide a lot of assistance through our PVR division there. I think it has its own appeals process because it used to be its own division, and it has its own director.
Back a few years, it was a big thing.
So I think that's still out there. But, one of the areas we're looking at in PVR is trying to get language that allows an aggregate CLA. We were talking about common levels of appraisal. So now you have merged districts, and you do have a lot of friction and issues with small towns. And I've been in one and challenged our CLA before when I was in Moortown, where there are so few sales that there are a lot of questions about, is this actually a valid, way to go about it? Well, with districts merging, we think it's fair to give these towns the opportunity to have an aggregate CLA and look at all the sales in the new merged district, if they choose to, as an option.
Sense.
Yeah,
then you have a larger sample size, and you would have to think about coordinating when each town does their reappraisal, because it'd be hard to do if town one reappraised last year and the other one. You could still do it mathematically, kind of figure it out, but that is an important thing we have to do with a statewide property tax for equity, but it's never short on controversy. How we do it and how it impacts.
Because it took so long, that used to be the businesses paid more than the individuals than property owners. But because nothing has been new in the business world, it flipped. So we were all real happy about that. But,
well, and it really depends on what town you're in too, because on average they're going to be about the same. But if you're a high spending town, you're probably your homestead tax rate is going to be higher than your municipal.
Okay, just one more was my favorite thing is pilot. Do you get involved much with payment in lieu of taxes and the formula? Oh, you don't?
No. Well, do I personally? No. Does my department? Probably.
Because we tried to get the pilot calculation adjusted back Mary Hooper and I, Mary Hooper from here, and we tried to make some changes in that, and there was a lot of resistance to change pilot. My favorite thing is for the nonprofits, they should pay like for their building in 2 acres, and then the rest be like we do for what is it, for a home?
Oh,
in 2
for,
acres?
yeah.
Yeah,
Yep.
same concept.
For homestead
Yeah, for
exemption,
pilot.
yep.
But anyway, so you don't get involved in that. So
I haven't yet. There's been enough drama just on income tax and education
Exactly.
financing.
That's always a
yeah.
big issue. We had a lot of meetings up at the State House about trying to get the calculation. There's a lot of things like towns like Barry who host a courthouse.
Yep.
They have a lot more, well, they say, and I sort of agree with them, that they have a lot more people moving in there that they're responsible for.
Right.
So,
Well, the pilot, current use, property tax adjustments, going to, all of these things. I remember when I was going to a lot of Vermont Society of CPA meetings, just as an accountant, I remember seeing when Richard Westman was commissioner
yes,
for
right,
a while.
right.
He was doing a presentation on really just raising awareness on how we're narrowing the people who are actually paying the full amount of property
Exactly.
taxes. And you can have different value judgments about whether you feel that this exemption or that exemption is appropriate and good policy, but at the end of the day, we all need to recognize the consequences when only 30% of Vermont
right. We're all in
homeowners
it.
are paying the
Yep, I
full
agree
property
with you.
tax. And current use, very popular program to encourage working landscapes and all that. But let's acknowledge that what we're left with all these exemptions is when we talk about the property tax rate, very few people paying the full amount at the there's a
we're always looking
consequence.
for them to pay more, too,
Right.
aren't they?
Yeah.
They're
Well, it
always
almost
paying
seems
attention.
like, without fail, whenever NPR does a show on property taxes, someone calls in to complain about current use.
Exactly.
Like, never fails.
It always incites passions for sure on both sides. So
I was checking out your website, and there was a lot of information about fraud, can't even say that word, fraud and theft and
Yes.
cyber security.
Yeah.
You must be very involved and worried about.
yeah, we're the new computer system we have has access to great kind of screening tools and red flags, and we have a fraud manager in there, and I've seen them working kind of in the war room, so to speak, where
Yeah.
they're looking at what's getting caught up and flagged, and so the capabilities to prevent and detect potentially fraudulent refund requests is really good. Nothing's perfect. It's just like any cyber crime. It's a game of cat and mouse.
Right.
We figure out what you're
Right.
trying to do. We close that hole. But it's a constant threat. It's something that last year with the new rollout of VTax for personal income taxes, that's what caused a lot of our delays was being...
Oh, I was going to ask you about that.
Yeah, we were being
Yeah.
really conservative
Yeah.
about this new system, and we didn't want to send out, the IRS sends out billions of dollars of fraud, and you don't get it back. It
Right.
goes to a bank in Nigeria or something,
right.
and it's very difficult to pull back once you send it out. So there's always this balance between getting you your refund ASAP
Yeah.
versus
'Cause
making sure you are you.
You were a little late last year.
We were late
yeah.
last year. We acknowledge it. This year, I just looked at our report today. Last year at this time, we had submitted 17% of income tax refunds requested, and we're at 39% this year. So we're more than twice
Great.
as responsive this year. But a lot of that was recalibrating that fraud detection
So most
tool.
of it, the major fraud you deal with is people putting in fraudulent tax returns? Is that
Yes,
too simple
it's
to
basic.
say that?
Well, no, that is it. I mean, the cause of adjustment. So you have fraud and you have improper payments where people are being a little aggressive or abusive on what they're asking for, or not including someone in household income. So we have screening, for property tax adjustment. We have the information to know if John and Jane are living in the same household. Remember, property tax adjustments are based on household income. If they only file with John's income and look for twice the property tax
Oh,
adjustment, we'll flag it and say, no, you got to include Jane's income as well. And so you can't get away with that one anymore. But,
Right.
but yeah, I think the major type of fraud is fake, stealing employer information. So, there's a whole dark web out there filled with information and that people can purchase and find out Social Security number, where you
I
work,
know.
and create. So it is it's identity theft at some
Yep.
level, and so we have to be very vigilant. We don't have built into our revenue estimates any estimate for fraud.
Right.
You know, the IRS, like I said, you know, just I think for staffing and resource issues, you know, they let a certain amount go, and we've kind of taken a zero tolerance policy in Vermont, and we're doing a lot better, more efficient with it this year than last year.
So we have about 3 minutes left.
Okay.
I want to ask about the per parcel fee for water quality.
Yeah.
Is that moving? Is that something you're following at all? There's all kinds of plans out there right now on what that could look like.
We are, you know, I have my staff sitting in on a lot of the natural resource committees where those discussions happen. You know, I was part of the Clean Water Funding Working Group, chaired by Julie Moore, the Secretary of ANR, this summer, and there was more discussion on that working group about it as well. It's, you know, I think it's still a threat out there. I think the administration also sees that as a new tax or fee, and understanding that in the long term, we need to deal with this issue and find revenue sources for it. But there's a solid plan in the short term to finance the known uses and needs for clean water spending. The per parcel fee, you know, the big thing for me as a tax administrator is there's no agreement on who would administer it, and not a lot of understanding of the cost to administer it.
Because I was surprised you were sort of hinting you'd be the one to collect it, and I just thought that was an A&R thing for some reason, but a tax is a tax.
Well, if you think about, you know, municipalities are hesitant to add it to their property tax bill, and so people think, well, can't the tax department, and that's been out there, can't the tax department just do it? Well, believe it or not, and I pushed back on this estimate, it would cost us about $4 million a year to administer that.
Right, because you don't have an infrastructure in place to collect
exactly
property
right.
tax. The municipalities do that.
Right. We don't, and that's really what people need to understand is that we don't send out tax bills. You know, people voluntarily file, and then we review it and say this is right, compare it with other information. Property tax collection is a whole other game where you're sending out bills and you have an appeals process, and we don't do that. If we took that over, we would have, or took on a per parcel fee that, you know, is estimated to collect about $16 million. We would have to completely replicate the infrastructure, the mailing, the appeals process that happens at the local level, and that would cost about $4 million annually. So,
well, we've done several shows on clean water, because they've been talking about this since forever, and it's such an impact on our economics. I mean, our economy, the whole state is impacted by what happens on Lake Champlain, and so I'm surprised that they're they're choosing the folks that live on the water. I don't know whether that's something as a state we should all participate in, because
well, the per
we all
parcel fee
benefit from it.
is looking at things like impervious surface statewide, and that's where it gets difficult too. Although there's great technology, mapping technology to assess, but think of the appeals that would come the first year. You get a brand new tax bill from a brand new entity that says, because you have, you know, a quarter acre of pavement and this much roof space, here's your fee, and you know, it'll be difficult. So, but
all of a sudden I perked up, because it will be other people around the state. So,
well, if it starts moving, we'll have to have you back to talk about it. We'll do a whole show just on that.
Right. I'm not sure what'll happen this year with that, but.
So anyway, we really thank you. See, it was a quick hour.
You're right, it was.
It goes fast, so thank you all.
We're starting another one at 6.
Yes, exactly. Thank you for tuning in. We'll see you next week, and in the meantime, keep listening beyond the sound bites.